Hey, today we're going to be discussing CALHFA's Dream for All program, and I felt that it was important just because we're getting a lot of responses about it in real time to send out an email blast, just kind of highlighting the features of the program, also discussing obviously how you can have an opportunity to shot at some of that 300 million that's going to be available to homeowners at the beginning of next year in 2026 in California. So essentially, CALHFA's Dream for All down payment assistance shared appreciation program is geared towards first-time home buyers who are purchasing single family condos, manufactured homes, right? So if you're purchasing a duplex, triplex, 4-unit property and beyond, this program would not be for you. If you purchased a home, you're not a first-time home buyer. If you purchased within the past 3 years, you're not considered a first-time home buyer. If you're also not planning to live in the home within the first 12 months of buying the home, this program is not for you, right? So this program is for a first-time home buyer, a home buyer that's looking to purchase a single family home, right, which is a standalone property, or a condo, or a manufactured home, townhome, all that good stuff fits into that, right, but not multiple doors. This program's also you have to also be a home buyer that's going to live in the property. So a lot of times we're purchasing properties, and we plan on having a renter take ownership or live in the home and pay for our mortgage or a part of our mortgage. But this program, you do have to at least live in the home for 12 months before you can put a renter in that home, right? So be mindful of that as well. And it's a conventional loan product, right? So conventional loan product, specifically for this program, you're going to need to have at least a 680 credit score or higher. 680 credit score or higher is going to put you in the game to qualify for this program. You're going to need to have at least 2 years of consistent work history, or if you have 12 months of work history, we can make that work, but we can't have any gaps in between there. You're not technically required to come up with your own funds at all. Obviously, they're giving you 20%. But what we typically tell people is you want to be prepared for at least to have 2% of your own funds available. Or we're going to be able to get that from the sellers also. So maybe you don't have the funds, but we can negotiate with the sellers to cover that cost, because the program does charge 2% for us to finance the program and provide it to you. We do charge the 2% for that program specifically, right? So those are just a few things to kind of get into, and I'm going to actually get into their handbook for the program. It's pretty simple, honestly, as far as like what you receive, right? So Dream for All is a shared appreciation program, and the idea is that, hey, we're going to lend you 20% to purchase a home, and in return, we're going to ask for our 20% back, in addition to 20% of the equity growth that you have, right? So you're going to give them the 20% that they lent to you, that 100,000, that 80,000, that 120, whatever that number is. In addition to giving them back what they specifically gave to you to purchase the home, you're going to, in addition, be required to give them 20% of the equity growth when you sell your home, if you sell, when you refinance, or at the end of the 30-year term. So this part has is a bit of a big controversy for a lot of people, because they're like, hey, I've been paying this money. Why would I give them any of my equity? Danny, when should I give them my equity? Should I do it right away, as soon as I can, right? So that way they're not hitting that most of it, most of my equity. Should I do it at the end when it's the big, that whole thing is kind of hard to say, because it depends on the person's situation. Some people are selling their home because maybe they got a job relocation. Some people are refinancing because the rates are just dramatically lower and they want to get a better rate in term. Caveat, the program does allow you to refinance at least once before you have to do the shared appreciation or give back the funds. So that should help a lot of people with that challenge right there. But it's just hard to say one size fits all what should work for a person. So what I suggest is that, when that time does come when you're thinking about whether it be selling, refinance, or, obviously closer to 30-year terms, which is 30 years from now, if I'm still in the industry, or who knows what the world gonna look like in 30 years. But you should definitely consult with myself or you know, a mortgage professional and write down that plan and what it looks like. I, in my personal opinion, don't think that it's that big of a nuisance, just because some people, most people using this program may not purchase a home if not for this program. So if you're not going to purchase a home at all, because if you don't use this program specifically for those people, then you giving them a portion of, you know, of what they're requesting is not necessarily harmful, because you're still going to make some profit in return. That's just how I personally see it. But then there are also those people that, you know, obviously understand, like, hey, like, I've invested over the past 10, 15 years, you know, $3,000, $4,000 a month, which equates to X amount of dollars. And, you know, I'm selling this home, I'm refining this home. I want all of that, you know, back to my pocketbooks. I understand that as well. Then it just becomes, hey, don't use the program. There are other programs that are grant options that can help you purchase a home. Still, you're not getting 20%, but you're getting something to be able to purchase a home, or, you know, find a way to save over the next few years and put that money to work for yourself, right? So those are the things that you know, just in a nutshell, how you know, the program itself, I think, is a good option, but it's hard to say specifically, you know, what you should do early on, right? We haven't even got the home. We don't know where the home is. It's kind of hard to dictate that. So I tell people, obviously you want to begin with the end in mind, but you want to be mindful of things that you can't control, right? If you're going to be taking assistance or help from someone, you can't dictate how and when they give it to you always. So that's just something to be mindful of. The shared appreciation is a big component of this program. It's something you want to wrap your head around. And what happens is you complete an application with me. After you complete an application, once January rolls around, if you are selected, we begin work on what shared appreciation looks like. Well, I'll probably do that with you beforehand, but you will get some itemized information with the help of CALHFA and myself about what shared appreciation looks like. So you're going into the process fully aware of everything, and you're prepared, you know, for that purchase, right? But just to make sure we're identifying everything, right? Be the first person to purchase a home. You also need to be the first generation home buyer, right? And currently be a resident of California. So my Vegas, Arizona clients in Texas, a few in Louisiana, Florida. This program is not for you, right? So this is going to be specifically for California residents only. You are going to be required to potentially take a Homebuyers education course. Sometimes they kind of allow you to not take that if your score is over 740, but I don't think it hurts you to take the Homebuyers education course, because it's just more information, especially as a first-time home buyer. You want to know what you're getting yourself into. I can explain everything to you, but it's always good to have that additional person available that is giving you direct information as well. In addition to that, another important factor, because I've had quite a few clients in the past that have talked about this program or wanted this program, and they've tried to add family members on so they can boost what they qualify for. Anyone that's going to go in a home loan application that's going to aid in you being able to purchase a home at a bigger value, has to live in the home. If they don't live in the home, they can't go in the application. It is completely that simple. I do not make the rules. This is directly from them, right? So you have to understand that if you're going to live in the home, you're all good and dandy. If you're not going to live in the home, you can't go in the application, right? It's just that simple, right? Because they want to make sure that people are not being investors and kind of scamming the system, right? So non-occupant co-borrowers can't go in there. So if you're not going to occupy the home, you can't go, you know, essentially on the loan, right? In addition to that, they're going to do, you're not going to be able to be on the deed as well. So it's little small stuff that you want to pay attention to. And I think that's why every situation is different as far as if you should use this program or if it's a good program for you or not. But like I said, overall, I think this program itself is self-explanatory, right? I've seen in the past of clients that I've helped an $1,100 payment shift from putting 20% down versus 3.5%, 5% down on a home, right? At most, right? $1,100. So that is something I can say is a lifestyle change, right? If you're going to purchase a home and you're going to have, let's say, a $4,500 payment, Most people may say no, most people say yes, but now their funds are tight. However, there are people also that are going to spend and have a $3,400 a month payment. Now, $3,400 or $4,500, I would say, which one would you want to be in? And clearly you want to pay the lesser of the two evils. But if you're going to purchase a home and you're going to be able to have a $3,400 payment versus a $4,500 payment, I think it's a no-brainer for that individual, because now they're still able to do maybe the things that they want to do with their family. Maybe they have this dream of getting this specific car that they always wanted to get, but they are always told to wait until you get after the home, purchase the home. These are things that, you want to be cognizant of as the benefits of this program, right? And not let just the idea that, hey, I got to give some of this money back to California, essentially, be the reason why we don't use the program, because I think it does offer a lot of benefits. The program has a maximum loan to value. A maximum debt to income ratio of 49.99%. And what that basically does is, we as the mortgage professionals, we look at your income, we look at your debts, and we just make sure that that income versus your debt ratio does not exceed 49.99% on approved credit as well, right? And anything over 49.99%, we don't qualify you. So essentially, we just make sure it fits in that box and you're good to go. Not too much work in that, but that's just something to be mindful of. You get essentially up to 50% of your income versus your debt ratio to put towards qualifying for a home. And I'll make another video where I actually go into detail what that looks like, the debt to income ratio. We'll do a shared appreciation video just so you can kind of see the framework behind that. But all in all, that's the program, right? So just to kind of highlight the features, pretty set and simple. You need to be owner occupied. You need to live in the home to purchase the home. And I want to make sure I don't miss anything here. You need to be a first-time home buyer. Obviously meet the credit score requirement, which is 680 credit score or better. Oh, also if you have multiple home buyers, right? So if it's me, my wife, my brother, me, my mom, my dad, who and you're all living in a home, of course, everyone's mid FICO score has to be a 680, right? So it's not just a one person has a 680 and I have a 600. Everyone's mid FICO score has to be a 680. We don't combine the scores. We don't add them up and divide. It is Experian, TransUnion, Equifax. I have a 680, 700, 720. 700 is your middle FICO score. We're good to go. I have a 640, 660, 680, 660, your FICO score, you don't qualify. It's that simple, right? So you look at the three scores that you have. As long as the middle score is above 680, as long as the second score, right, is 680 or greater, you're good to go. So if that last one and only one is under 680, you're okay. But we need to have at least two of our scores 680 or greater to qualify for this program. Obviously, and another, I forgot to mention this. As long as one of the buyers are first-time home buyers, as long as one of the buyers are first-generation family, you're good to go, right? So, for example, me and my wife obviously own a home. Let's say, for instance, my wife never owned a home, and I own this home always clear and free by myself, all that good stuff. And she comes along and she has never owned a home. Well, because my wife has never owned a home and is the first in her generation to be a homeowner, we're good to go because she fits that requirement. So you only need one person to check that box. You guys all as a collective do not have to fit in that box, right? So they're doing this just because there are so many people that want to use this program and have help from family members, have additional forces that allow them to be able to purchase kind of already a little bit easier. So they're just doing this to kind of be able to weed out those people. Get to the people that do need help and otherwise would not have any assistance anywhere else. So I do think that's actually a good thing for them to do. And once again, I'm going to be sending in this email, I'm going to be sending that link to the application. If you're someone that's interested in purchasing a home at the beginning of next year, it's important that you lock in with me right now because I think in the past 4 days, just about 4 days basically, since this program has been live, I've been talking to people and we've had 7 applications. And that's not even me really promoting it or saying anything. And obviously not to mention all the other hundreds of thousands of loan officers that are out there that are preaching to their community, hey, this program is available. So you want to get the ball rolling ASAP. You want to make sure that your credit score is in check. So I'll be able to review your credit score. If your score is not at 680, we have essentially, 60 to almost 90 days to get your credit score at least a 680 or greater. We want to make sure that we're doing that. We want to, obviously check and make sure that you do qualify for the program, that if you have anything that is on your credit that we need to make sure it's not available or not there. If we want to increase what we qualify for, we have a few days, a few months to put a plan together to do that. Whatever it is, I just always think that you don't want to go into January and trying to do an application and then finding out that you don't qualify, or being in a situation where you got some things to work on that you could have started and got the ball rolling now. So if you're interested in purchasing a home, if you're a first-time home buyer, if you're first in generation, or if you or your significant other or your brother, whoever that person is that's going to be purchasing with you, it is a first-time home buyer, and you're wanting to use a program that will possibly give you, up to 1,100% payment shock difference. I think this program is a good opportunity. And I don't see why you should not at least try to see if you qualify for the program, or any other programs that we have for that matter. But I think this is a good opportunity for you. So definitely complete the application, and then we'll follow up with a time and date that works best for a phone call, and we can strategize about how we can get you in a home in 2026. But be ready, because it's going to be fun, and I'm excited to be able to help. So if you have any questions, please do not hesitate. Feel free to directly email me back from this email, and let's get going. Let's go.